What is up, YouTube? What's up, guys? The Composer Trader here, and today we don't just have another regular post-trading analysis video. No. Today, we are going to be discussing the swing short position that we are still in that could turn out to be one of the most legendary trades of this entire cycle. Now, before we're going to dive into the technicals behind the setup, and elaborate on why we entered where we entered and why we are targeting where we are targeting, I want to clarify that this setup has already been provided all over my socials. From the pre-planning aspect to the actual live execution through multiple posts and even a public live stream to the whole trade management aspect of it, it has all been traded live. So this setup and this model and this entry, it shouldn't come as a surprise to any of you listening right now. However, I wanted to make one compact video to simply refer people back to when they ask me as to why I did what I did and why I executed and targeted these points. So we're going to combine all the information that has already been provided into one compact video to have something to refer people back to. Okay? And obviously, it's part of our daily trading recaps. So let's start diving into the charts right here. And for this model, it is extremely important to understand the context. So we need to dive deeper into the context right here of the macro environment on Bitcoin, because that is also building the confidence behind the overall expectation that we had of a redistribution model taking place. So really starting from high time frame to low time frame right here, basically what we had going back into around Q4 2024 and Q1 2025, we basically had this range formation right here that at the point of time and at the point of distributing in this environment, I was looking for a potential higher time frame distribution schematic to develop in this high around 100-ish K right there, where if we follow our structure, simply making higher lows and higher highs, we can see a low, we can see a high, and we can see a higher low for a higher high right there. This was basically our structure. Structure is trending up. We're looking for a distribution model. We're pulling that range from high to low. And right there, you can see that initial range high, and you can see that second deviation right there. So we had this distributive model in here where we were at the time looking for price. Right here, we were looking for price to start sweeping that extreme liquidity, which is that first lower high getting created right there. If you follow the market structure from that second tab high down towards the low, you can see the lower high for the lower low, and you can see price delivering that first lower high in combination with those equal highs, and this is where we were looking for that potential distribution model to take place from either a Model 2 or a Model 1 perspective, and then simply short that back down. Now, as you can see, price back then never established that proper higher time frame distribution model, and we simply retraced back down to around 74-ish K, and as we were coming down right here, we were leaving behind a lot of buy side liquidity. You can see price here stacking up a lot of highs, right? We have all these highs right here where each and every high is a lower high compared to the previous one, and therefore we're stacking up a lot of buy side liquidity. So we basically had failed higher time frame distributive price behavior at the highs, and we were coming down creating a lot of buy side liquidity above, and that led me to create my market maker manipulation playbook. And in short, what that market maker manipulation playbook represented was the fact that I was expecting a higher time frame range formation to form in here with the purpose of getting distributive price behavior at the highs. So what that means is that oftentimes, in order to create a higher time frame range, what you'll see is that price has a lower time frame breaker structure back to bearish, and the purpose of that lower time frame breaker structure is simply to create a higher time frame range in here. This is a concept I talk about also in all and every single mentorship regarding, range theory and advanced range theory, but it's super common for price to get that breaker structure and then get that rotation back up to the high to get that deviation and then get your Model 1 or your Model 2 distribution from there. Okay? Now, the reason why that works for the people wondering is because lots of people can identify a market structure break. They're going to be trying to short the lower high with their invalidation above the previous swing point, creating a lot of liquidity above that, which makes for a very nice liquidity sweep opportunity for market makers to sell and short and offload positions and then distribute and reverse price towards the downside. That's why it works very good, because it traps a lot of retail traders into only people understanding just simple market structure terms that everybody looks at, right? So as price was coming down right here, basically March 8th, we released that market maker manipulation playbook, and my expectational order flow was to get an accumulation at the bottom right here to get the rotation back up and create a higher time frame range like this, okay? That was the initial pre-planning. Higher time frame range creation with macro distributive price behavior for the reversal back down. Now, what we saw right here is that price had obviously this structure demand from our previous high time frame reaccumulation schematic, and right here we had a high probability structure demand that we just front ran. So in that market maker manipulation playbook, and I'll probably in the bio of this YouTube video, we'll make a link towards the X post elaborating on the market maker manipulation playbook if you're interested in having a read into that, because it's basically what price has been respecting ever since March 8th of 2025. Right here, what we were pre-planning was for price to accumulate at the bottom right here, get the rotation back up, and actually delivering a front run of that demand, increase the probability of deviating at the highs, because price is simply not grabbing the fuel that is required to deliver a proper expansion towards the upside from a continuation perspective. So we got that model 1 accumulation right here, as you can see, and we got the rotation back up. And from here, we were looking for macro distributive price behavior. Now, for anybody that has watched the mentorships, you guys know the difference between a range deviation and a range breakout. And the way that we determine that is by looking at our deviation limit, our DL2, right? Which is simply right here, it is our 1.3 and our negative 0.3 of our range, okay? So this area right here from our range high up until our deviation limit, that is all price action, which can be vulnerable to simply being manipulation. If price gets a proper break above that DL2 right here at around 120K at the time, that's when we can talk about getting that continuation expectation where price is making higher lows and higher highs, and you're simply continuing with your swing structure that's making higher lows and higher highs, right? Deviating in that DL2, that's when we're looking for overall distributive price behavior. So we can see that price action came back up here. We deviated that high, right? Grabbing the liquidity from that previous all-time high. And then we came back inside the range, okay? We came back inside the range right there. But as we were coming down, we can clearly identify that on this pullback right here, in this pullback from high to low, we are leaving behind a lot of buy-side liquidity, okay? We're creating, again, all these lower highs, where each and every high is a lower high compared to the previous one, and we're stacking up those highs, which are creating buy-side liquidity. Again, if market makers are intended to distribute and reverse price towards the downside here, they're going to use that buy-side liquidity to offload positions. So if price is going to get an aggressive reversal towards the downside and aggressive distributive price behavior and macro reversals, you're not going to be coming down leaving that buy-side liquidity. Okay, so as price was developing in here, we were expecting another rotation back up to that high for potential model 1s, PO3s, overall distributive price behavior, okay? Now, as price deviated, we extend that range high to the deviation high. We're going to be extending that range to the right there, and we can see that we were getting, right there, a push back up above that second tab high right there, but we remained inside of that deviation area, right? That deviation limit. And we can see price retracing back down here. But as we're retracing back down, guess what price is doing? We are leaving behind buy-side liquidity on the retracement. Again, if the market is intended to have some sort of an aggressive reversal towards the downside, you're not going to be leaving behind that buy-side liquidity. They're going to grab that buy-side liquidity to offload positions, and then if we truly see them ready to reverse price from a macro perspective, we'll be seeing those aggressive expansions towards the downside. That didn't take place right here. So we were looking for potential PO3 where this was the range, that was the manipulation, right? Back then in a live market environment, we were like, hey, this could be some sort of a ranging environment right here. and this could potentially be that manipulation, where then right here we have that range formation with those two tabs at the highs right here, tab 1 and tab 2. And then if we get an aggressive close back inside the range, that confirms the expansion phase and the macro reversal towards the downside, right? That's basically what we were analyzing at that point in time in a live market. But to anybody that, again, has watched the mentorship, you know that first, you preferably want to get a distribution model in the manipulation phase, and that's where you find the entry, where in this case, that wasn't the situation. There was no distribution model here. It was just a two-tab model. But also, the PO3 itself is confirmed if you get an aggressive close back inside the range. Only if you get an aggressive displacement back inside can we actually confirm the rotation back down to the range low. So when we're analyzing that price behavior as we're coming down, you can clearly see that yet again we deviate that high and we're coming down, creating a lot of buy side liquidity above right here, where you can see all these highs where each and every high is a lower high compared to the previous one. So yet again, yes, we are deviating the highs over and over again, but as we are deviating the highs, we are coming down, creating a lot of buy side liquidity, and therefore that indicates that price is vulnerable for yet again another move up. So market makers might be distributing, but they're not ready to reverse price yet. They're still offloading positions at each and every single high. When you can truly expect a macro reversal, that's when you can see a proper aggressive displacement towards the downside. That's when you're shifting your focus. So we can see price deviate the high. We come back towards that range point. We extend the range high to the deviation high right here, and we extend it to the right, and then price yet again comes back up right here. It comes back up and it deviates that high again. Right here on October 6th, we deviate that high again. And now this is where things are becoming very interesting, because we can see all these deviations prior right here. Every single deviation prior, it's yet again taking that high, but it's leaving buy side liquidity above as we are coming down, which you can see in every single blue box that I've highlighted here. That completely changes, okay? That completely changes the moment we see our aggressive sell-off right here. This is the sell-off. This is the reversal that you want to see when you're expecting a macro reversal to take place. This is giving the shift in macro price behavior. We have been deviating the highs over and over again. We have been exhausting towards the upside, okay? Buying exhaustion. This right here indicates the start of the actual macro reversal, because for the first time after all these deviations at the highs, can we actually see price displace aggressively towards the downside? Okay, so because of this aggressive displacement towards the downside, as we were approaching our weekly market structure low, which got wicked right here because it was a massive liquidation event, but as we were displacing aggressively, this aggressive displacement, okay, this to me gives me the expectational order flow, which is a fancy term of saying what I am expecting price to do next, to create a lower high for a lower low, to reverse price back down to the start of this macro distributive environment, which is going to be right here at that range low, right? We were expecting macro distributive price behavior. Price has done nothing but respect that thesis. Now we finally get that displacement towards the downside. So now I'm looking for that lower high for the lower low, and I'm looking to trade that using our TCT distribution model concepts. So it's very important to understand that context building, and that's why I'm taking my time elaborating on it, because it gives extra confidence in the range that follows next. Because locally right here, in this range, we can see a low, we can see a high, we can see a higher low and a higher high. I'm following this market structure from that wick low towards the upside. And because we're making local higher lows and higher highs, I'm pulling that range from top to bottom right here, okay? Pulling that range from top to bottom. And then right here, we can see that we have that range high, we have a range low, and we have our deviation right there. Now this is where we're going to be slightly zooming in, identifying this range. This range right here, I was expecting for this range to develop a redistribution model, meaning a distribution schematic, but because we're already delivering a lower high, it's a redistribution model. This at the highs right here will be the actual distribution because it's the distribution coming from an uptrend. Now we shifted that into a reversal towards the downside, lower high, lower low, redistribution model. But I'm trading, it's traded the exact same way, but I'm focusing on the TCT distribution model right here to take place. And as price is making its way back up towards that range high right there, we are creating a textbook return to zone right here, where price is coming up, leaving literally nothing but sell side liquidity below. In other words, the return to zone is the most important variable to determine if we have a high probability model taking place. If you have that textbook return to zone, you are setting yourself up for an extremely high probability model. So the context for the lower high, the context for the redistribution model itself is already extremely high probability. Now we have the individual model giving us the characteristics of also a high probability schematic. So context is in our favor, and the model, due to this textbook return to zone, is now setting itself up for chef's kisses. Okay, absolutely chef's kisses. But what we can see right here is price comes up, deviates at high, and comes back down towards his local demand POI right there. Okay, it comes back down towards his local demand POI. Now, from there, we get the rotation towards the upside. As we are coming down here, price is establishing that second tap, and we have to identify simply where that third tap might take place, right? What is our extreme liquidity? What is our extreme supply? Or is there a POI above the second tap for a potential Model 1 distribution? Now, price right here came into a very high probability supply POI, where if you pay attention to my previous YouTube video where we talked about pump fund, this is that exact same supply as that supply on pump fund, right? Is that supply that created that liquidative part of the move. So right here, we actually also had a short position that has already been discussed in a post-trading analysis video on this YouTube. But nice little short position from there. But we were still creating that range high at that high probability supply POI. And right here, we simply grab the liquidity from that initial starting point, but we're still located in this overall supply level. Okay? Still located in that overall supply level. But we deviate that high, we come back down. As we're coming back down, we're retracing into structure demand. And from there, we analyze, okay, what can be our potential third tap play for our actual distribution confirmation? Now, analyzing right here, you don't really have any proper supply levels created at that second tap high. Like, you can scan through your time frames, but there isn't really anything. There isn't really anything in this environment, right? So what I was basically doing is using this as my higher time frame lower high right there, using that as my extreme liquidity, where on the higher time frame, like the 1 hour, we simply have price having a high, a low, a lower high, a lower low. It deviated back above that point again, but that was a fake breaker structure before the reversal towards the downside. Again, you will never get trapped in entering on the breaker structure there because you're looking for a distribution model. So that's now acting as that market structure point, which is the first market structure point created from that second point, from that second tap high. So that's acting as your extreme liquidity. And we obviously are watching that range high right there for a Model 1. Now, because this high already grabbed the previous market structure point, I was paying less attention towards this. I was leaning more towards a Model 1 distribution schematic because of the lag in a high probability third tap POI. Does that mean it needs to create a Model 1? No, not at all. It can still create a Model 2. But because the POI for the Model 2 was lower probability, it was less likely to happen, I was also focused on the Model 1. However, the moment you grab that Model 2 POI right here, market structure is going to be king. If you see aggressive breaker structures back to bearish, you're going to trade the Model 2. You're not going to wait for a Model 1 because the Model 2 POI was slightly unclear. No. That's your liquidity point. If you get aggressive breaks, you're still going to be entering that. No questions asked, okay? So we're having this POI for the third tap from a Model 2 perspective, and we're obviously having the range high. Now we can see price moving back up right here from that demand mitigation low, and we're making our way up towards that extreme liquidity. And right here, now things start to become very, very interesting, because analyzing price action right here, at this point in time, we had New York open at 14:30 because we had that 1 hour difference with America due to time zone changes. So 14:30 to 15:30, this is that first hour of New York. So we have our third tap POI located right there, okay? This is that extreme liquidity sweep. We get our New York open, and in that New York open, we see price expand towards that third tap. So we see price expand towards that third tap on the New York open, the first hour, and then we see a super aggressive sell-off, breaking structure right there, back to bearish. Okay, we see a super aggressive sell-off, breaking structure back to bearish, creating structure supply right here. This can be a potential third tap of our high probability Model 2 distribution in an extremely high probability environment from a context perspective for a macro pivot, and we get New York open, push price up, and then sell off aggressively. Now, for the people that don't know, the first hour of your session opening can oftentimes deliver amazing manipulation. We're reviewing that first push of the session as a manipulative move before reversing for the rest of the remainder of the session, okay? So we see New York open, we see that aggressive breaker structure. That's all that you need to know. You get your quality breaker structure, and it is in confluence, okay? It is in confluence with your session opening. That is your confirmation for the Model 2, okay? That is the confirmation for the Model 2. That breaker structure is going to be your entry, and then the stop loss is going to be above that third tap high right there. But this is going to be the setup right here. And the target, obviously, is going to be the range low. That is the technical target, where you're operating on around a 12 RR. If you enter at the exact breaker structure right there. Now, I entered slightly later, so I was operating on around a 1 to 9-ish, between 9 and 10 RR. But that is going to be your entry. Okay? That's going to be your entry. Now, I can already hear the question. But Lars, isn't the third tap right here, isn't the third tap a bit narrow in duration compared to tab 1 and tab 2? Meaning the time displacement between tab 1 and 2 is way larger than tab 2 and tab 3. And you're completely correct in saying so. However, whenever you have a high probability return to zone to the point where you can draw that return to zone literally into that market structure low where you're almost entering on the breaker structure, if you can draw your return to zone straight into that point, your third tap can be more narrow. The reason for that, the rationality behind it, is because there is nothing to support price, right? There's nothing to support price to then bounce and deliver a higher time frame third tap, because there's nothing but sell side liquidity, which the return to zone represents. So you're just expecting a flush towards the downside, right? Now, in these scenarios, when you get a breaker structure that is this quality and price delivers that lower high for the lower low, creating yet again another supply POI, you can always anticipate on an EHP model, okay? I'm not going to explain an EHP model right here in this video. It's TCT Mentorship 2025 material, but I have already explained on YouTube as well for the people that really want to get to the nitty and gritty of it. But you can always pre-plan or expect price to get that aggressive sell-off as you're seeing it happen in the live market, create a supply POI, and then price later on can come back for that supply POI for a higher time frame 1, a higher time frame 2, and a higher time frame 3, because these two taps merge together, okay? So then if you enter right here on that breaker structure, which you're allowed to enter on because, you know, the return to zone is so good, even if you end up going into a higher time frame model too, you can simply add more. You can simply chill the stop loss towards that high and then add more on that breaker structure. But your model and your invalidation point is not going to get triggered, right? So don't miss out on a legendary entry opportunity when everything is so aligning perfectly just because the time displacement was just barely a bit too tight. No, the return to zone makes up for that in these environments, okay? The fact that you even get this high probability of a model on the macro scale is already insane. Now, from there, price delivers the lower high for the lower low. We're coming back down. Right here, as price was developing a ranging formation, we were looking for TCT and TCT, meaning the moment you have this breaker structure confirmation, you have your entry, you're targeting the range low, right? You're targeting the range low right here. So whenever you have a confirmed order flow objective, meaning price is supposed to come to that range low, you can look for low time frame models in the range and get a high time frame target. So we were establishing a ranging formation in here that I was looking to short if we got a redistribution model. So I was looking at this range, looking for redistribution schematics to take place. What you're going to see develop here was a very nice high probability environment right there, where we're taking that range high. Boom. So you can see right here that price was establishing a very nice lower time frame range. Let's keep the price action pretty clean. Right here, we were establishing a very nice low time frame range. Again, this is TCT in TCT. And I was looking for that redistribution model on a lower time frame in here. With our 1, with our 2, and then with our potential 3. And then get that refined entry on a lower time frame third tap and then target at higher time frame low. But either way, price ended up reversing back towards the downside, completing the distribution model from the high right there to the low. Okay, now this is also where we hit our significant profits. Okay, this is where we hit our significant TP and where I cashed out 50%, the technical target. However, the remainder of the 50% is going to be targeted all the way back down towards this low right here. So the trade is operating on like a 1 to 40 RR right here. And this is the setup. Now, as we were approaching those lower levels, we had one key POI. And that one key POI was, at that point in time, the volume area low. I can see that Bitcoin USDT has slightly different data. But we had a support level right here on a lower time frame, just some demand. It was located at 101.6, which is still valid. I'm trading on USD inverse, but now I'm doing the technical analysis on USDT because I don't want to mess up my chart in here, but maybe I can still see it. Yeah, this is the actual live trading chart right now. And we had that key demand level, as you can see, right? We had that key demand level aligned with that macro volume area low. And that is basically your make or break it level. Like below this level, there is literally nothing for price to react of. It's literally all just inefficiency and liquidity, right? So going back to the USDT chart right here, this is our macro setup, okay? And if we play that to the current date, you can see where price is currently at within this overall model. Now, right here, we can see that we have that aggressive expansion. Let's make that red. And then right here, if we clean this up to really put it good into perspective for you guys, we've got this aggressive expansion right here. We got the redistribution model right here. And then we got the second aggressive expansion right here. Okay, so what I want you guys to understand now is, do you see the difference in price behavior compared to these previous all-time high deviations? Can you see the shift in trend and the shift in literal market maker distributive behavior compared to these previous deviations? Because guys, if you can identify a pattern early, you can benefit off of it early. because we identified this pattern early of that shift in behavior of getting aggressive displacement towards the downside, we profited off that 116K short, where the rest was still looking for higher prices because every single time we deviate the high, we went higher. But now there is a change in character. There's a change in behavior because we're getting aggressive displacement towards the downside. So you can see right here that we have this high time frame range, and every single move up right here deviating left behind that buy side liquidity, where you have a fast move up and a slow move down. And now we're seeing a fast move down and slow moves up. It has changed. And unless we kind of extend this along, like to the right, unless this keeps on deviating right here and deviating and deviating, and it's looking like an accumulation, right? Then we can start targeting higher prices again. But until that happens, the macro target of this macro overall distributive setup is going to be this range low right here. And that is why we are targeting at that 74K level, which is that macro range low. Now, from a TPing perspective, the way that we're going to be managing this trade is that right here we have a very significant liquidity level. This basically highlights the fact where that liquidity push started. We can see right here that we had that Model 1 accumulation, and then we got that aggressive push up from that accumulation schematic right here. And then from there, we got that slow grind up, leaving these lows right here. You can see these liquidity lows. Now, I'm not really expecting a reaction from these levels. It's just a liquidity push, but there's no volume here. So price is not going to be spending a lot of time in this area. So we're either going to absolutely slice through it and sell off, not spending any time in here, or we're going to simply wick it and then push back up, also not spending any time in there. So these are the two scenarios. So I'm looking for a TP around 91-ish K if we see some sort of wick and bullish breaker structures. But the macro target, as we're managing this trade, is going to be 74. And if price ends up magically reversing from here, which I'm not expecting, right? But if that magically happens, because we are trading this TCT system, we have these refined entries. We've already realized close to 4% on this trade. We already realized 4RR. It's a guaranteed winning position, even if I get stopped out on the remainder of the trade. It's a guaranteed win. So, like I always say, we can predict macro pivot points on extremely low time frame breaker structures, getting these very high RR setups that even when we're wrong, we're not losing money, or in this case, making money. And when we're right with a lot of size. Guys, we have been pre-planning this since March. This is just our macro thesis coming to fruition in a live market environment. Nobody else is doing this shit, okay? So it's been a ride, right? It's been a ride, and there's nothing left to do but wait and simply see how price is going to be reacting at these levels. If we go up slowly again, we're looking for another redistribution opportunities, and we're riding the shift in trend, and then probably when most people start to catch on the shift in trend, that's when we'll shift back to some sort of a relief rally, okay? But hope you guys understand this. I don't want you guys to just follow me and believe me and trust me. I want this to be rational and understandable to you so it makes sense to you, because then you can make the best decisions for you and don't have to depend on anyone else, including me, okay? So I appreciate every single one of you for listening and tuning in. I respect your time, and I'll see you all later. Peace out.